So I'm sure you're aware, but if you're not, British Land's a FTSE 100 real estate investment trust. We primarily invest in commercial property, have been around for quite a chunk of time. The company traces its origins back to 1856, but the more modern company was formed in the 70s. And today, when we look at the portfolio, we have two key elements of the portfolio. There's our campuses and what we describe as retail and fulfillment. The campuses represent about 70% of the portfolio. And what's a campus? So a campus for us is an environment in London that has great transport infrastructure. It benefits from high quality buildings, great public realm, and it's in really prime locations. And so our three campuses today that are established and developed are in Paddington in the West End, Regent's Place in the West End, and Broadgate in the city. They're primarily office led, but they do have a really important element of amenity, and that's amenity retail and leisure that makes them great environments. And we'll come on to this, but we really like the campuses because in a world where office occupiers are becoming more and more discerning about what they want and their focus is on the best space, that's very much what our campuses provide. They're in the real top echelons of office space in London, and we think that's exactly where you want to be. People might work from home a bit more, but all of our office customers are saying they want better space, so that's where demand is. And actually it's the supply of high quality space in London that's most constrained. And then the other part of our business is retail and fulfillment. And today that consists of retail parks, and I'll come on to why we particularly like those, and shopping centres, but we're looking to broaden out retail to include urban logistics, and think that urban logistics, particularly in London, will be a material part of our retail and fulfillment business as we look forward. The portfolio today is 9 billion, that's our share. And when you take into account assets we operate for our partners, their share of those assets, we've got a portfolio of close to 13 billion. David, if you flick over the slide. Thank you. So we recently set out a new strategy for the group, and this strategy is really designed to make sure we play to our strengths and that we're hunting in the right markets. In terms of our strengths, really that comes down to our operational capabilities. We're a vertically integrated company, and so we do everything from finding the real estate, developing it, refurbishing it, actively managing and repositioning those assets. And that's the skill set that really stands out. You know, we've created some of the best buildings around London. You probably know the Cheese Grater. As I mentioned, our three London office campuses are known for the very high quality real estate they provide. So when we're using those skills, we tend to deliver the best value for our shareholders. So I want the business to be more and more focused on development and active asset management. And then we're investing behind those two key themes I laid out, our campuses, and that's about providing that high quality accommodation in London for our office occupiers. I mentioned the three campuses, and we'll come on to the opportunity we've got to deliver a fourth campus, which is a development site that we have in Canada Water, and then retail and fulfillment. For us, we think retail parks are looked to perform well going forwards. That's down to the affordability of the space, but importantly to the way in which they support online and also attract online resilient occupiers. And I'll come on to this in a bit more detail. And we're delivering our strategy through the four priorities set out on the bottom of the page. That's capturing the value from our campuses, and we're going to do that via the developments. opportunities we have there, but continuing with the approach that we've adopted for a number of years, which is making sure that we're targeting customers in growth sectors. So over time, we've changed our campuses to appeal to faster growing businesses. So, for example, Broadgate in the city was much in the past about financial services, traditional financial services. And as we came out of the financial crisis, we realized that financial services weren't going to be the engine of growth they'd been in the past. And Broadgate sat at the northeastern edge of the city, next to Shoreditch, next to Spitalfields, and we were seeing fast growing businesses in technology and creative industries. And so we looked to encourage those to come to Broadgate, and we did that by giving them a reason to come. And that was about creating really great public realm, the type of buildings they wanted to occupy, but also really improving the amenity retail, the bars, the restaurants to attract them. So we're going to continue to that approach of making sure our campuses appeal to winning sectors, winning industries. I've mentioned the development opportunities we have across the business. That's our second priority, making sure we're making the most of those, because that's where we drive really good returns. And then in retail, there's two elements to it. It's really making the most of what we describe as the value opportunity in retail parks, but also growing this urban logistics business. And we'll do all of that whilst recycling capital more actively. And that's so that we're focused on those situations where we're developing, where we're refurbishing, and we're going to be less about holding more mature assets and collecting income. So that's the four priorities that underline our strategy. And David, if we flick over the slide. Thank you. And this was from our full year results, where we showed our progress against the priorities that I've mentioned. And you can see them on the screen there. These have moved on again because we provided another update last week with our AGM. But we think we've made some really good progress with leasing activity across our campuses. Really pleased to have attracted JLL, the big global property advisory business, to our One Broadgate development, even before we commenced demolition of that building and putting up the new building. But we've continued with the leasing momentum in recent weeks and months as the economy's opened up, and our pipeline of deals is very encouraging. And then on the development, since November of last year, we've committed to our One Broadgate development, which will be the home to JLL. We've committed to Norton Folgate, which is a scheme that we have is adjacent to our Broadgate campus in Shoreditch, very suited to tech and media occupiers, and we're seeing a good level of interest there. And then just more recently, after this slide was produced, we've committed to our Aldgate Place development, which will be our first build to rent scheme in London, and something that will be important as we look to Canada Water, because that's got a very big residential component. And we've continued the pace with Canada Water. It received planning last year. We've started enabling works, and we're about to place the main build contracts for the first phase. So very exciting period for us. On the retail side, we've taken advantage of this value opportunity that I'll come on to in retail parks. We've acquired 200 million of retail parks since November, and actually acquired an additional retail park last week that increases that to nearly 300 million. And that's a park that will be suitable for conversion to urban logistics, and I'll mention that in a little more detail. And then we've been busy on the capital recycling, so selling mature assets and recycling that capital into our development program where we can drive attractive returns. David, if we could flick over the slide, that would be great. I've touched on this, I won't go into too much more detail, but this is really about how we create value. And in yellow, you can see the activities that drive performance. This is about creating the best real estate. We do that via development, but also we do it via active asset management. So I mentioned Broadgate, where we took our existing campus asset and we repositioned it to appeal to fintech, to media and creative industries. And one thing that we're looking at is our Regent's Place campus, which has a very fortunate location in that it sits in the middle of the Knowledge Quarter, which is the home to the Crick Institute. And you've probably seen that there's quite fast growth anticipated in life sciences. And so we think there's an opportunity for us to provide the real estate that those life science businesses need. And being close to the Crick Institute in the Knowledge Quarters, really important for those. So we're looking to have a similar repositioning of Regent's Place that we've had at Broadgate. A few examples there of us recycling capital in the period, and I mentioned a couple of the acquisitions that we've made. So it's about making the right acquisitions, it's about managing them actively, developing, and then when we've got more mature assets, we'll look to release capital so we can continue to create value. And David, if we can move over the slide, that would be great. So this is our office, primarily campus business today. You can see that we've got 9 billion of assets under management. We own 6 billion of them. You can see our 3 campuses across London, so Paddington, Regent's Place and Broadgate, established campuses that are income producing today. And then the opportunity I spoke about to deliver our 4th campus at Canada Water. And Canada Water will be more of a mixed use campus than Regent's Place, Paddington or Broadgate. It will have a big residential component alongside offices or workspace and retail and leisure uses. We think that's one of the most flexible planning consents that's ever been achieved in London. I'm very excited to get underway with the project. And I think if we flick over the slide, we've got examples of why the campuses work for us. And I touched on these, but it's really about what makes great accommodation for our customers. And they're focused on a number of important themes. Obviously, there's the quality of the buildings, and you can see in the picture 100 Liverpool Street, which is a development we recently delivered, and feels like one of the best buildings in London. It's leased incredibly well. But a really important component of that building has been the sustainability credentials. So sustainability is really important to us as a business at one level because it's the right thing to do, but also really importantly, sustainability is a key requirement of our customers. So if we can deliver them sustainable real estate, we think they will pay us more rent and we will lease space more quickly. And that's certainly been evident by how well the building 100 Liverpool Street leased, but also the One Broadgate development that we're getting underway with. Sustainability was right at the heart of that business. And many of our customers have set their own net zero targets, and their biggest component or footprint of their carbon emissions is their accommodation often. And if we can address that for them, then they'll pay us more rent and we'll lease space more quickly. The campuses provide really good transport infrastructure. They sit next to key transport nodes. And as I mentioned, public realm and amenities, really important. It's not just about work, it's what people can do in and around work. And then one thing that works really well across our campuses is our ability to provide flexibility. You will have heard this theme that office occupiers want more flexibility. And we do that at one level because we control all of the buildings in a particular location. So that means that businesses can grow with us. And we've got lots of good examples of businesses that started very small, and we've been able to help them grow and find new accommodation across our campuses. And equally, some businesses struggle or for other reasons decide to shrink, and we can deal with that and we can lease the space to someone else. And we have in our campuses and across our business, a flexible workspace operator. Ours is called Story. It's a profitable business in its own right, but it's really important to our product offering because it means that not only can we provide flexibility to some of our existing customers and they can take space with us for say 2 years as opposed to on 10 and 15-year leases. Most of what we do is 10 and 15-year leases, but a small element, about 5 to 10%, is those shorter leases. If they've got project space or they've expanded very rapidly, that's good. But the other reason it really works is it allows us to attract smaller dynamic businesses that like to co-locate alongside traditional businesses. And we've seen that at Broadgate with fintech businesses have wanted to locate next to their bank. So an important element of our offering. David, if we could flick over the slide. I mentioned the development program, good track record of delivering profits via developments. Developments have delivered about 2 billion of profit to British Land over the last 10 years. Schemes that have recently completed are One Triton, fully let to Dentsu Aegis at Regent's Place. They're the Japanese marketing business. 100 Liverpool Street, we talked about earlier. And then 2 developments that are underway are One Broadgate and Norton Folgate. But we've also got the schemes coming through, Canada Water, which we've got a couple of slides on in a moment, 5 Kingdom Street, a big planning consent that we have up at Paddington. And then there's schemes that are a little bit further ahead. 2 and 3 Finsbury Avenue will be the next phase of Broadgate. And then we have some opportunities like Eden Walk, where we can take existing retail schemes and deliver mixed use environments. David, okay to go over the slide? So I touched on attracting growing occupiers, and this slide here just highlights some of the fundamental of life sciences. In short, it's about increasing government investment. It's about being, relative COVID winners and the role that those industries have played. But also we're seeing that healthcare is overlapping with technology, and that's where we think the opportunity is. But we drew out life sciences as one example, but really it's much broader than life sciences. When we think about innovation, it's about big tech, it's about artificial intelligence, green industry, science and engineering. The slide, David. Thank you. Got some stats here on Canada Water, and probably what I draw out here is the flexibility of the planning consent. COVID would happen, but we knew that on any 10 to 12 year big development project, there would be changes in customer requirements and we would need to be flexible. So we deliberately built that in up front. And to give you an idea of the flexibility, we can flex between delivering 2,000 residential units or up to 4,000. And the amount of office space or workspace, 500,000 square foot to 2.5 million square foot. And we can bring that forward in whatever order that we want, which is really important over a program of that length. And in terms of returns, because it's got that flexible consent, because we've assembled the land relatively cheaply, we think that we can deliver double-digit and in fact low teens IRRs from the development phase of that project. So that's every year an annualized return from development in the low teens. And Canada Water is very suited to attracting some of these innovation industries. And what's helps with that is having education uses, and we're really pleased to have brought Teddy London. It's a university's partnership between King's College, the University of New South Wales and Arizona State University, and they're delivering an engineering curriculum now at Canada Water. And we built them a module, what we described as a modular campus, in 9 months, so they're able to get underway, and that starts to create the critical mass for other occupiers to come in alongside them. So as you can tell, a project we're very excited by. And David, if you quickly go over, I'll just wrap up on the last elements of the strategy, which is around retail and fulfillment. So this is the illustrative scheme for Canada Water. We can flick through these. Thank you, David. And then coming to retail and fulfillments, the pie chart shows our retail park portfolio today. Over half of it is retail parks of our retail portfolio. Retail parks, like all of retail, have certainly struggled in recent years with online and the changes we've seen there. But actually, in more recent months, what we've seen is them be much more resilient than the broader retail market, and that's because basically the rents have got to the right level so that our retailers can trade profitably, and we've got choice as to which customers we lease the space to. We can either lease the space to fashion operators at rents where they can trade profitably, or we can bring in other occupiers like discounters, Aldi, Lidl, Home Bargains. So when you've got choice as a property business and you've got competitive tension, that helps. So although rents have come down a long way, we now believe they're stabilizing, and we believe that there's a real value opportunity because the pricing of retail parks has moved to an extent that the yield is attractive, and in a world where rents are stabilizing, we think we can drive good returns from that. And we talked about double-digit returns in our most recent results, and it's the improving occupational outlook that's important, but it's also the fact that many of our parks or many of our occupiers on our parks use their assets to support their online operation. So they do click and collect. Over 85% of our occupiers allow their customers to do click and collect. They use them for returning goods. It's much cheaper for a retailer if a good comes back to store, where someone else might make, where the customer might make an incremental purchase. And then the other bit really is around shipping from store. And because these are high quality boxes, the retail parks on the edge of major towns and cities, during the pandemic, they've been used more and more for shipping stock directly to the customer from the store. And we think that's an area that will expand. So retail parks, in essence, are affordable, and they support online operations, and we've got choice as to which occupiers. So with yields where they are at about 8%, we can deliver attractive returns. And I think this is probably on the next slide. So David, if we can flick over. Yeah, this is what I was describing. So the first point is affordability, complementary to online. They're the preferred format by many retailers. If you look at recent announcements by Next, Primark, M&S, they talk about the better performance of their retail parks. And although they might be shrinking their store estate, they're looking to expand in parks. And the other thing is, because these often come with lots of land, they're modern boxes, they have alternative uses in a downside scenario, and one of those could be full-blown use as logistics. So that makes it interesting. And then on the right-hand side, we've set out the maths of why we think we can get double-digit returns, which we can maybe pick up in Q&A if people are interested in that. And then if we just flip over the slide, this is about the crossover. I mentioned how the parks are being used more and more by the retailers to support last mile, but we also think that a number of retail parks will end up being converted to urban logistics, because urban logistics rents and capital values have risen as capital value and rents have come down in retail parks, and many of the parks tend to be in better locations. And we also think that on some of our parks, although most of the park will remain with traditional retailers, we will be leasing space alongside that to logistics operators. And then the last aspect of our strategy, which is picked up, is really how we make even more of this crossover with urban logistics. David, if we could flick over. And our belief is that urban logistics, and this is particularly within the M25, will see really strong rental growth. The fundamentals are very compelling. I don't need to tell you why. We've all seen the growth of online. That's is just going to continue. The trajectory is very clear there. But in particular, we've seen this increasing customer expectation for faster delivery times, and even same day or within an hour or 15 minutes, as you've seen from some of these grocery businesses. And that's against a backdrop, particularly in London, where there's no space available. There's virtually no space for those businesses to take. So you've got very strong occupational demand with virtually no space. So that's when you get the conditions for very strong rental growth. And so what we believe is that because London is our patch, you know, we're experienced developers, we've got great relationships with all of the boroughs, with the planning authorities, that we can deliver the product that's going to be needed by the customer. We're not going to buy our way into this market. The logistics real estate market is very hot, but we can develop the new products that's required. And we see three themes to be able to enter this market. And David, if you could click over the slide, that would be great. You know, this is why we're well placed. I've mentioned the London expertise, but it's really about, sorry, if we could go back, it's really about the types of solution. And we think there's three avenues where we've got a clear competitive edge. The first is that in and around London, retail parks will be converted to logistics, and we're best placed to lead that given our retail park expertise and our development expertise. And in particular, we acquired one recently last week in Thurrock. So it's right on the edge of the M25. So ideally placed to be converted to logistics and to serve London. We think that one of the solutions, because the demand is strong but there's no supply, will be in established logistics locations to increase density. So this is taking existing logistics asset and delivering multi-story, and that was the rationale behind our Enfield acquisition. It's an 11-acre site. The planning environment's very favourable in Enfield, so we think we'll be able to double the size of that asset, and that helps us drive returns. And then the last element is the true last leg in central London, and this is where people need goods, need to get goods to customers very, very rapidly. And because there isn't any obvious land to deliver new logistics solutions, it's going to be part of mixed use, and we're very much a mixed use business and developer. And obviously we have our campuses, and we think that including logistics solutions within our existing assets and future assets is something very obvious for us to do. So that's the strategy. That's where we're looking. David, I don't know if you want to pick up on dividend, and then I perhaps wrap up with the outlook. I think there was a slide on the dividend just there.
Sure. What I might do is just run through very quickly the results for the year, and then maybe what we referenced in the operating review last week, and then finish off on the dividend before I hand over to Simon. So for those of you who don't know, we're a March 31st year end. So as you'd expect, given that timing, the results clearly reflected the impact of COVID. Profits for the year, £201 million, down 34% versus the prior year. Key drivers for that, really, I'd flag provisions that we had to take for outstanding rents. That was on the retail side of the business, and I might touch on that later. The asset sales we made, £1.2 billion worth of income producing assets, buildings that we sold through the year, overall 6% ahead of book value. So we were delighted to execute those deals in the context of today's market, ahead of book value. But clearly when we sell assets, there's an impact on the income, and together they accounted for £25 million of rental income, which had an impact. And then 10.6% decline in like-for-like rents, principally, again, it was on the retail side of the business where we saw 17% declines. But half of that retail rental decline was as a result of CVAs and administrations that we've seen from retailers, with the other half being a result of lower rents, longer void periods at some of the units through the year, and then lower income related to COVID. For example, lower car park income through the year Offices actually just -1% in terms of like-for-like rent, so pretty stable on the offices side. Offsetting that, developments coming on stream. Simon touched on a couple of those, most notably for us in the financial year, 100 Liverpool Street, and then more to come with 1 Triton Square PCing just after the end of the year, and now the commitment that we've made to Norton Folgate and 1 Broadgate, and together those committed developments will add a further 5.4 pence to EPS once they come on stream. Leasing performance underpinning that activity, pretty resilient actually. On the retail side of the business, we let 1.7 million square feet of space in the year. That's actually the highest ever, albeit we are having to be pragmatic in terms of the rental levels and the pricing at which we're filling that space. So 1.7 million square feet, but overall 19% below previous passing rent, i.e. the rents at which we were able to let that space previously. And we exited the year actually with a pretty encouraging pipeline of the deals on the retail side, with almost 600,000 square feet within the pipeline. And what we're encouraged by now, and we alluded to this last week, is that we're now starting to do deals in line with our expectations at the moment. So in line with ERVs, which is essentially where the market or where the valuers would expect us to be letting that space. So that's encouraging and gives us comfort that we are starting to hit this inflection point on the retail side of the business. Office leasing clearly more subdued for obvious reasons through the year, but again, as we've exited the year, encouraging signs there. So 183,000 square feet of office leasing since the end of the year, and that includes 134,000 square foot, which was pre-let to JLL at 1 Broadgate and allowed us to commit to that development. And then on the Storey side, the flexible office business within British Land, activity levels now back above pre-COVID levels. So again, a subdued year on the offices side from a leasing perspective, but encouraging signs as we exited the year. Then on the balance sheet side of the business, net tangible assets, which used to be called NAV, now called NTA, 648 pence at the end of March. It's down 16% year on year, and clearly the main driver there is the portfolio valuation movements, minus 11% overall, and within that minus 25% on retail, minus 4% on offices. But I'd probably draw out some sequential patterns that we saw there, which again we think are quite encouraging. On the offices side of the business in particular, for the second half, valuations off less than 1%. So exiting the year there with offices broadly stable on a valuation basis. And I think that is encouraging to us, especially versus where we thought we might be this time last year, when people were starting to think about the future of the office, the future and what that might mean for the office investment market. And then on the retail side of the business, a slowing down of the rate of decline as we exited the financial year and for the second half, and in particular, encouraging signs in that retail park segment of the market, which Simon has alluded to. And again, thinking to our operating update from last week, we are starting now to see that inflection point come through. And for those retail park assets which are valued quarterly, which albeit is just a subset of our portfolio, actually a small positive in the first quarter of the year to June for those assets. So again, I think really encouraging on that side of things. Further on the balance sheet, LTV, the end of the year, 32%. It's down 200 basis points in the year. It's down 370 basis points in the second half off the back of the disposals that we made, partially offset by the decline in valuations. And strength across the balance sheet, £1.8 billion of cash and undrawn facilities at the end of the year. No requirement to refinance until early 2025. And crucially, we think, and something that's been really important to us over the last 18 months or so, no income or interest cover covenants on group debt, and significant headroom. So we could withstand a further 46% decline in the valuation of the assets, which we think really has helped position us well for the challenges of the last 12 months. And then that brings me on to dividend, which Simon alluded to. I'll just flip back up to, I think it's slide 20 from memory. Could be wrong. Oh no, I'm right. So immediately post-pandemic last year, we took the decision to temporarily suspend the dividend. That was in the face of what was clearly significant uncertainty in terms of outlook, so we could best protect our own financial position, but also make sure we could actively and appropriately support our occupiers through that period of time. We wanted to resume dividends as soon as was appropriate, and we did so in the autumn of last year, so as early as we could. But we refined the dividend policy at that point in time. Going forward, dividends will be paid at a fixed 80% of underlying earnings per share, and they'll be paid twice a year based on the most recently reported 6-month period. We like that because we think the fixed payout will mean the dividend maximizes our strategic flexibility going forward to deliver on the plan that Simon's outlined. It will automatically flex to take into account acquisitions that we make, disposals that we make, developments as they come on stream, and of course, trading conditions as they change over the time. And it will continue, of course, to mean we are REIT compliant, so able to pay our dividend at the appropriate level to remain and retain that REIT status. Overall, therefore, that meant that we paid a dividend for the year of 15.04 pence. That will be paid to shareholders on the register in August 2021. But with that, I might hand you over to Simon so that we have enough time for questions you may have.
Thanks, David. Probably makes sense, Mark and Alex, to go over to questions, do you think?
Fantastic. Yeah, no, thank you, Simon. Thank you, David, for that presentation, for so clearly articulating the strategy of British Land and all the things you've had to do over the last year. Just as a reminder to people, if you want to ask a question, there's a Q&A box at the bottom of your screen. Just type your question in there. If you do see a question that you want to ask that's already been asked, just put a thumbs up next to it, and we'll deal with those questions first. We've had a couple come in ahead of time too, so we'll see if we can catch those at the same time. So let me just start off with the first question, Simon, and then you can decide if you want to take it, or if it's very tricky, pass it on to David.
Almost certainly.
That's the story of my life, but he's used to it the other way around for a few years, so I'll let him off.
So anyway, first question, build to rent seems as a new sector, how will you deal with any political issues such as rent controls and security of tenure?
I do think that's a great question, and when we were thinking about our strategy and direction of travel, we were very conscious of what I'd say is the increased likelihood or possibility of regulatory involvement in the residential sector compared with commercial. It just has a different, it's more of a political hot potato. So that has been in our minds. We see our build to rent as very much part of our mixed use. So at somewhere like Canada Water, we will be selling residential units. Actually, in the first phase, what we will build will be sold, but there will be some later phases where we think build to rent is interesting and will deliver good returns. One thing I would say is that I think as a sector, compared with sort of buy-to-let landlords, the institutional build-to-rent, where you're building purpose-built, high-quality accommodation for the residential market, there's much better understanding that the politicians have of that and much better support of it, and they're now seeing it as part of the solution. And although rent controls have sometimes been mentioned from time to time, it does feel like we're quite far away from that. But we shouldn't be complacent about that, and we will be very careful on that if it looked like the mood music was changing in that regard. Actually, we think there's some areas of the build to rent market which are absolutely positively embraced by the politicians, that can generate some really good returns, particularly the delivery of key worker housing. So alongside for sale, full market rental housing, we have requirements to deliver key worker housing, social housing, and particularly with the key worker housing, given the fact that you've got a waiting list of what are high quality customers. It's the same product that you would provide. It's provided at a discount for planning purposes, so you get a guaranteed customer base, very few voids, which gives it a gilt-like income stream. That's really prized by the institutional investors. And if we can create that type of product and then sell it to institutional investors, we think we can drive good returns for our shareholders. So my two things would be, it's part of our mixed-use strategy. It feels like it needs to be because that's where the market is. And I think there'll be pockets where actually we can take advantage of what happens to be the political flavour at the moment.
Okay, thank you, Simon. Another question here. Two good strategies, but would it not be best to demerge, given that the retail parks logistics are likely to trade at a premium to NAV, resulting in a lower WACC?
Yeah, it's something where people often think, where you've got diversified REITs, would there be merit in demerging parts of the business? We're a big believer that as British Land, we have the skills to be able to hunt in these particular markets. And maybe the thing that we've really tried to land with the strategy is the idea that where we're invested will change over time. Today, we see the best opportunities as campuses and this retail park urban logistics crossover. We want to drive returns for our shareholders then. But if, for example, retail parks reprice materially, you could easily see us then exit those. So I think there could be, you could argue by separating out parts of the business, there could be a one-off bump of, I'm not convinced in that, but sometimes you see that situation. Today, we actually believe that we don't trade at a discount to where the individual parts of our business would trade at. If you look at the peer group, we actually trade at a premium, and over time we think that should be a substantial premium. We need to develop a track record of delivering, choosing the right sectors, recycling capital actively and generating returns for our shareholders. But I'd like to get to the position where there's an ongoing premium relative to the value of the constituent parts, and obviously our shareholders benefit because we're able to be nimble and change with changing requirements from our customers.
Thank you for that. Another question here. What level of incentives are you having to offer in the office and retail sector to gain or retain tenants? And I guess there's a related question that came in on email, which said, how often are you actually giving discounts to your customers at the moment, and what level of those discounts coming at?
Sure. Maybe if I take the first part around leasing incentives, and then if David picks up on some of I think the question's probably around some of the concessions we've given in the past for, to help people through COVID. So on the first part, lease incentives in the London office market moved out a little bit. We tend to be a bit better than these, but to give you an order of magnitude, for a 10-year lease going into COVID, probably the incentive was somewhere like 20 to 24 months for a 10-year lease at a headline rent. That probably moved out about 3 months during COVID. So we've not really seen a material change, and that seems to be the case across the broader market. We typically, if it's a 15-year lease, it's 36 months. If it's a 10-year lease, it's 24 months. And those might have moved out, as I say, a couple of months during COVID. And we expect that as the market picks up, they'll start to move back the other way. In retail, for our leasing activity, I think in our latest year, we leased for an average length of 7 years, and the incentive we were giving was about 4 months there, 4 to 5 months, to just give you a flavour. Interestingly, in retail, because of the environment, incentives have actually probably reduced. Landlords are less willing to give long incentives because of the perceived elevated credit risk that you have, because you've seen more failures in that space. We've always been very careful around them, but they are an element of the market, but haven't particularly moved during COVID.
Yeah, I mean, that's spot on in terms of the retail stats for the year. I mean, in terms of discounts, there's probably two parts to that question. One is kind of how does the market overall feel? As I said earlier, the leasing activity that we did through the year was on average 19% below what we call previous passing, which is the previous rent associated with those units. We are starting to see rental tone now stabilize on those retail park assets, but at a level which is very materially down from peak, 30-40% down from peak. We think that's the right thing to do. We're being pragmatic to fill space at the right price. Much more focused now on quality of underlying occupier, quality of underlying covenant than lease term or price. We know the right price for those units. We want to get them full. We think that's the right approach. When it comes to concessions related to COVID, there's probably a few different buckets. In the initial phase, for the small independent occupiers, which are so important to the success of our places, but under significant distress, we agreed to write off rents for a period of time. That was the right thing to do. It was the only way those businesses were going to survive. In the initial quarter immediately following COVID, we agreed deferrals for a chunk of our rent roll. Again, that was the right thing to do. But once we got onto a more stabilized position and we moved through the back end of 2020, early 2021, it was really about engaging with individual occupiers to work out the best solution for them. In some cases, that will be partial payment. In some cases, it would be agreeing rent freeze for the period of closure. In other cases, with the more successful operators, though, it's also included discussions about taking more space, increasing lease terms, et cetera, rolled into a broader discussion about rent collection. But look, fundamentally, we've been clear we're doing deals which are below previous passing, significantly down on peak, but we think that's the right thing to do to keep the places full. And the other extended benefit of that, in our view, is it underpins the investment market for these assets. Because one of the challenges to finding buyers for retail assets was that the buyers or the buyer market didn't know where the bottom was in terms of rents. Now we feel like we're starting to find that. We think that's supportive to the investment market too.
Great, thanks, David and Simon. I've got two more questions that have come through on email. And just a reminder, if you do want to ask a question, just type it into the Q&A box at the bottom of your screen. Now that you can remove tenants for non-payment, how often are you doing this now that the restrictions have been relaxed?
Shall I take that one? Actually, the moratorium remains in place. The government have signalled, so this is the moratorium on the ability to evict tenants for non-payment of rent. They've signalled that it will be lifted and no later than March 22, but it remains in place today. Interestingly, as David outlined, we've seen improved rent collection and in recent quarters, particularly this last quarter, and that's been more about the improving economy and the loosening of restrictions and the ability of those tenants to pay their rent, as opposed to our ability to take action. The main avenue that exists today is county court judgments for non-payment. And so, in the middle of a pandemic, we're a responsible business. We look after the long-term value of our business, and that means our customers. So we adopted a very supportive approach to particularly the independents. We'd taken a long time getting the right occupiers in place. But since the reopening of retail, the improving trading, and our stores are trading well, footfall and sales on our stores are good. So the vast majority of our occupiers are trading very well. So as David signalled, we're taking a more robust stance, and that's in line with the government guidance. So if people are not paying the rent, and they should be, then we're very happy to use stuff like county court judgments, and that's totally in line with the government's guidance that those that can pay should pay the rent. But obviously we're very flexible during the period of distress, and I think that's responsible as a business and the right thing to do from a commercial perspective. I think it will incrementally help when the moratorium is lifted, just because of its signalling properties. But what's most important is actually that retail opens up and trades well, as it is doing at the moment, and remains open.
Okay, thank you. Another email question here. With some companies talking about a new flexible approach to working in the office versus working from home, will that lead to less demand for office space And given that there is a shortage of housing stock in the UK, is there potential for you to convert any of your office space properties into apartments?
Yeah, as we covered in the presentation, just to bring out in a bit more detail, our sense is people will work from home a bit more. It was a trend that was underway anyway, but I think COVID has clearly accelerated that. We do believe that there is fundamental value in the office, and I think as COVID has dragged on, more and more people have seen that. A lot of the CEOs I speak to, outside of the real estate space, talk about the erosion of company culture. They're very worried about their staff, particularly the ones that are young or joined during COVID, because we all started our careers and we learned from the guy or girl at the next desk, didn't we? And that's not been possible. So that, because of company culture, because of the better ability for people to collaborate face to face, we're clear that people will want office space, but they're going to want better office space. And actually in London, the supply of high quality office space is very, very limited. And with sustainability, increasing customer requirements around that and collaboration, what we're seeing when companies are surveyed is that they're probably looking to move to better accommodation, a lot of office occupiers, and that creates an opportunity for us because we really are at the very top echelon of space that businesses want in London. So we think that the bulk of what we've got today will remain very high quality offices. I think it's very unlikely that much of our office space would be converted to residential. The higher returning use would be as offices, but I do think there might be scope in our retail portfolio. Some of our retail assets are valued at such a level where alternative use, whether that's logistics or residential, makes sense. And we actually acquired certain retail assets to create into mixed-use campuses. Canada Water was a retail asset. It's a big shopping centre today. It was a print works and a leisure park, and we're obviously delivering this mixed-use environment of offices, residential, and leisure. And there are other examples in our portfolio where we've done exactly that. So we might be able to take advantage of the distress in retail to create some big regeneration schemes in the future. So that's pretty exciting.
Brilliant, thank you. And I think we've got time for one more question here. So I'm going to take this one here. The IRR development returns quoted at low teens, I presume that's unlevered and excluding any allocation of central management costs.
Spot on. So unlevered and before central costs.
Brilliant. That sort of draws us to the end of today's presentation from British Land. Thank you very much to Simon and David, as I said, for presenting so clearly.